And we saw this last week where we would get tremendous selling pressure. So the open on Monday, really, this is Australia's Monday. It takes it from $3,058 down to lows just below $3,029.88. And then you've got this long consecutive series of green candles with strong volume that move gold back up to $3,075. Definitely countered the trend. And then you had a slow and methodical price decline for a period of hours. And that is kind of interesting. So you make this next low that comes in, makes it slow, and then it spikes back up. But that is a false spike in that it was a counter trend that you wouldn't expect and also unsustainable. And then you return, you make the lowest low of the day. And now we're sitting just above that, right around 3,000. So on a short-term basis, we've seen selling pressure. The selling pressure remains, but we're also seeing points when there is either an attempt to recover or people squaring positions off.
Gary Wagner, editor of thegoldforecast.com, clarifies the current gold and silver markets. This past week, we witnessed intense selling pressure, particularly on Monday, pushing gold below $3,000 before a brief recovery. Wagner breaks down a series of technical signals, including Fibonacci retracements and moving averages, to highlight areas of support and potential rebound zones. He emphasizes confluence between the 38% and 61.8% retracement levels, indicating that deeper cycles align beautifully. Silver also made headlines with a dramatic 15% drop over 2 days, but recent buying hints at short covering or belief it's deeply undervalued. Gary remains cautiously bullish, projecting gold could reach $3,500 in the second quarter. We present the latest clips of Gary Wagner's video. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
You can see that these are the last 3 days, Thursday, Friday, and today. Tremendous selling. And what I've done is I've created 2 Fibonacci retracement data sets. The first one is a short-term data set beginning at $2,875 up to the top that it was achieved on Wednesday. The longer data set starts down at $2,650. The lows in what I have labeled as the beginning of this current rally in the middle of December. $2,650 basically moved you up to a series of new all-time record highs. When you do this, the reason we're using 2 is we're looking for confluence between different cycles of moving averages. In other words, the time sequence. This one is much longer and much deeper. And so the 23.6% matches up roughly with the shorter term fib retracement at 38.2%. Now, obviously, it barreled through that. The next level that is interesting to watch would be this 38% retracement level that corresponds to the 61.8%. And the fact that you have these pure Fibonacci numbers, the 38 and 61.8, close together, in other words, there's very much the same resonance, but an octave higher or an octave lower. And you're getting that. This is beautiful confluence when you have the 38 to the 23 or the 61 to the 38, when they're that tight together, it tells you that even when you go out further in time, the cycle of itself matches up beautifully to these numbers. So I believe that we want to look at this current pricing. The low that came in today was $29.72. Of course, the key is going to be when gold is able to move back and sustain a close above 3,000, which it's struggling to do. And at this point, it is just at 3,000, 3,001. And this is June futures. A break below this, and you would have to look at the area of the 78% at around 29. But my sense is this is an area we want to look at. if it drifts further, let me actually go ahead and hard code that in. If it is unable to hold this current level, 2946 is at 78% retracement. That would be the next level. And personally, I don't think it would go much deeper than 2950, the 78% retracement. What I am saying is I'm going to have a harder time predicting when equities will begin to find some support. My sense is gold will trade to 3,500. It's the when that I'm a little bit more conservative than other analysts. Right now, I'm looking at the potential top of gold. And this, of course, our calculations done before the fall, but they're still relevant. Anywhere between 3,350 and 3,400 an ounce. 3,500 an ounce, if I had to calculate, I would have looked for a second quarter next year.
Okay.
It's not a matter of if, but when, because I believe that that's truly a logical price level for gold to ascend to, all things being equal.
Okay.
I am just a little bit more conservative than some that are calling for it earlier than I am. When gold was going down hard, silver was dropping 9% on Thursday, 7.5% on Friday. And interestingly enough, today it's actually up 1.9% or 56 cents after trading to an extreme low of 27.58. So it does appear as though silver is attempting to find some support and move higher from that. What's interesting is that, as you pointed out, there is a component that where we can call silver a sister precious metal to gold, because in some ways it does have a safe haven aspect to it. But the key component is industrial utilization. So why do we have silver moving up when equities are moving down? And some of those equities are companies that rely on silver for their end product. They use it in their production. Mm-hmm. So the one thing that is easy to surmise is that silver was hit so much harder. The decline in silver over the last few days of about 15% was so massive that there are traders right now that believe that it is absolutely undervalued. Another rationalization or another reason we could be seeing this is you've got massive short covering from those that went short when it was sitting at around $34, $35 and then dropped 15%. If you cover your shorts, you're putting a buy order into the market, and you would get the same symptomatic candlestick pattern that you're seeing here. This rally started middle of December at about 2,600, moved to 3,200. So you've had a tremendous move, $450, $650 higher since the middle of December. We would have to see gold drop at least 50 to 70% of that. And to give you an idea of where that was, before I would call this a bear market, we would need to see gold at 2770 to 2850, although I would look at this. The other thing that we would want to do is take a look at our moving averages. And I'm looking at a series of moving averages. This purple one, just give me 1 second, is a exponential 20-day moving average. This green one is what we look to define if it is in a short-term bullish or bearish trend, above or below. The next one is an interim bullish or bearish trend in blue. And then, of course, this is the notorious 200-day moving average, which tells you on a long-term basis whether or not gold is in a bullish or bearish demeanor. Flew through the 20. It recovered after trading below the 50-day. For us to say that, to respond that we are in a bear market, we would need to see a lot more technical damage, at least to break below the 100. Mm-hmm. Definitely, if it traded as low as at or below the 200-day, that's the definition of a long-term bear market. Below the 100-day is the definition of a interim bear market, and a 50-day moving average, the fact that it's currently above that, says that on a short-term basis, it has not gone into a bear market scenario.
Yes.
We would need to see gold trade below and then sustainably either trade sideways or lower. And the fact that it isn't, we can't make that observation, or we can't come to that conclusion that gold is in a bear market. Right now, it's not. It's corrected tremendous amounts of dollars, percentages, nothing in terms of the damage that's happening in U.S. equities, nothing like silver. And if we look at the moving averages, for example, in silver, it ripped through all of these. I believe that it is below the 200-day moving average, if I'm correct, but not gold. Gold would need to break and close below the 50-day moving average before I would even say it is in a short bear market. Right now, it doesn't meet the criteria of any of them.
Gary Wagner confirms gold is in a correction, not a bear market, highlighting that it's still trading above key moving averages, including the 50-day. Conversely, silver shows more profound technical damage, but may be rebounding from oversold conditions. Gary believes fundamentals support higher gold prices, making this a market to watch closely. Share your thoughts on Gary Wagner's analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.